Today we're going to talk about the PCORI tax. Typically these are for self-insured medical plans, but let's just call it the gift that keeps on giving, because just like every single tax, it's not going away. Now, PCORI is kind of a weird word. What it really is it's an acronym for Patient-Centered Outcomes Research Institute. This was part of the Affordable Care Act that was passed in 2010, and it's supposed to just do research into providing better outcomes in both for the patient and providers for healthcare. I'll be honest with you. In the many years since then, I cannot think of a single time I have seen anything from the Patient-Centered Outcome Research Institute in any insurance documents I've ever seen. So I'm not real sure what they're doing. But even though I'm not real sure what they're doing, one thing's for sure, they're expecting you to pay the PCORI tax every single year. So let's talk about who pays it and how it's paid. So first off, if you are the administrator of a self-insured medical plan, whether they call it self-insured, whether they call it level funded, you are going to be responsible for remitting that tax to the IRS. Now, if you're on a fully insured plan, that amount is built into the premiums. And so you are paying that, but it's built into the premiums, and the carrier, since they are the administrator of the plan, are the ones that are remitting that to the IRS. Now, when do you start paying those taxes? And this is a little complicated, so I set an example. When your plan year ends for your self-insured plan, you pay that the following July 31st of the next calendar year. So, for example, if your effective date is July 1st, that means the end of your plan year is actually June 30th. So you wouldn't be due to pay that PCORI tax until literally the following year, July 31st. So if you have a plan that renews in January or February, it may be 16, 17 months before you pay the PCORI fee for that plan year. That's a little confusing, but it's just the calendar year following the end of your plan year. So how do you know how much you owe? And how is that calculated? The way it's calculated is what we call a belly button test. And so it's not just the employees that you have enrolled on the plan, but it can also be their spouses and their dependents. So you're going to count everybody on the plan, including dependents, and that is your belly button count. Now, you're going to put this on the Form 720, which is a excise tax form that is sent into the IRS. Like I mentioned, it's due on the 31st, and the rate varies. It started out initially as $1, but now it's typically somewhere between $3 and $4, and it may depend on when your end of year is. A lot of people will use their accountants, or there's some services that will also provide this for you. Will this tax ever end? My bet is no. It became into effect 2010. It was initially supposed to run out in 2019. Of course, they added 10 more years to it. I bet as we get closer, they're going to add 10 more years to it. So for now, it's through 2029, but don't be surprised if it's continued. And as far as compliance, there's always a penalty when it comes to compliance. Now, this one is an IRS penalty, and if you don't file, of course, you'll be due what is expected for you to file, but it can also be additional penalties and interest, just like other things with the IRS. The PCORI tax is really one of the simpler compliance things that you have to deal with. And if that's something that you need some help with, we're absolutely here to help. We can walk you through it. Thanks so much for tuning in.